Welcome to Iraqi Dinar, your trusted source for the latest global currency updates, breaking financial insights, and all the buzz surrounding the world's most watched revaluation stories. Today, we're diving deep into a major development shaking the markets, the Vietnamese Dong. There's breaking talk about a new potential rate, and this one's got both investors and economists paying very close attention. So let's unpack what's really going on, what's being reported, and what it could mean for you if you're holding the Dong or following the IQD VND connection. Lately, we've seen a surge of excitement spreading across international financial forums and analyst circles. Reports are circulating that the Vietnamese Dong might be in the early stages of a controlled revaluation, something that's been discussed for years but rarely this seriously. The buzz is real, and this time it's being fueled by credible market data and signals coming directly from Vietnam's central bank, the State Bank of Vietnam, or SBV. The big question everyone's asking is, are we finally seeing the first signs of a real, measurable rate shift? Now, let's get one thing straight. The Vietnamese Dong isn't just another regional currency. It's the foundation of one of the fastest-growing economies in Southeast Asia. For years, the Dong has been carefully managed under a system known as a managed float, meaning the SBV sets a daily reference rate and allows small movements within a narrow band. This tight control keeps the economy stable and exports competitive. But recently, experts have noticed that those small daily adjustments are becoming a little less small. That's a big deal, because in Vietnam, tiny moves often signal major policy changes coming. So why is everyone watching now? It's because the timing aligns with something bigger. Vietnam's economy has been on an unstoppable growth path. Record foreign investment, booming exports, and solid control over inflation. Its foreign reserves are at record highs, and its manufacturing base continues to attract multinational corporations shifting away from China. All this adds up to one thing: economic power. And when a country's fundamentals get this strong, its currency usually follows. But before we jump to conclusions, let's understand how the SBV operates. Historically, Vietnam's monetary policymakers are known for patience and precision. They rarely make sudden moves. Every step is tested, measured, and data-driven. Their top priority has always been macroeconomic stability, keeping inflation under control and exports globally competitive. So if we're seeing sustained upward movement in the Dong, it likely means it's intentional, not accidental. Recent market data supports this. The Dong has been hovering close to 24,000 per US dollar, a level it's held for years. But analysts are now spotting subtle yet consistent strengthening patterns across different trading platforms. Those quiet upward shifts could be early signs of a recalibration, possibly the beginning of a controlled revaluation process. And that's exactly what's fueling this global discussion. To truly understand what's happening, we need to look at why Vietnam might be ready to let the Dong strengthen now. Over the past decade, Vietnam has transformed itself from a developing economy into one of Asia's fastest-growing powerhouses. It's become a magnet for foreign direct investment, with major corporations from the US, Japan, South Korea, and Europe setting up factories and technology hubs across the country. This inflow of capital doesn't just create jobs. It floods the economy with US dollars and strengthens Vietnam's overall financial position. The result? A massive trade surplus and rapidly expanding foreign reserves, two key ingredients that support a stronger currency. Economists say this is precisely the kind of environment where a revaluation makes sense. A stronger Dong would reflect Vietnam's economic maturity and boost global investor confidence, signaling to the world that the country is stepping onto a higher playing field financially. But, and this is crucial, there's always a balance to maintain. A currency that's too strong can make exports less competitive, hurting factories and jobs that rely on foreign demand. That's why analysts believe the SBV's approach will be gradual and measured. They'll likely allow small, controlled gains over time rather than a massive overnight rate change. This way, they protect Vietnam's export advantage while slowly modernizing its financial system. If you're holding the Vietnamese Dong or following its trajectory, these small moves can matter a lot. Even a modest revaluation can create meaningful returns over time. especially if you've been holding physical notes or trading through currency platforms. However, experts are quick to warn against unrealistic expectations. Vietnam is not going to flip a switch and double the dong's value overnight. Their history shows us they move carefully, one policy step at a time. Still, what's different now is the tone coming out of Vietnam's central bank. Recent statements from SBV officials have used words like flexibility, market alignment, and modernization. Those phrases don't show up by accident. In central bank language, that kind of wording usually signals preparation for a shift, one that could involve more market-based pricing and less rigid control over exchange rates. Vietnam's strong reserves, now among the biggest in Southeast Asia, give the government the confidence to make this move. They can afford to let the dong strengthen gradually while still having enough cushion to intervene if volatility appears. That's the luxury of stability, and it's one of the main reasons economists are calling this period potentially transformational for the country's currency policy. For clarity, let's quickly define the key term everyone's throwing around: revaluation. It means a deliberate decision by a government or central bank to raise the official value of its currency. It's the opposite of devaluation, which lowers it. And when you see talk of revaluation, that's generally a sign of strength. It means the nation's fundamentals are solid enough to support a stronger currency without damaging growth. Vietnam checks nearly every one of those boxes right now. Modern central banks, though, don't like surprises. They almost never announce large revaluations overnight because that can cause chaos in trade contracts and investor portfolios. Instead, they prefer gradual appreciation, small adjustments that the market can absorb naturally. Vietnam's likely doing just that, introducing minor tweaks, monitoring results, and preparing for a longer-term shift toward a more flexible exchange system. Analysts watching closely have identified three main indicators that could confirm where the dong is heading next. First is GDP growth. As long as Vietnam's economy keeps growing at around 6 to 7% annually, natural market forces will keep pushing the dong upward. Second is foreign investment. The more global corporations move production to Vietnam, the stronger the demand for its currency becomes. Third is trade conditions. A healthy global economy keeps demand high for Vietnam's exports, which in turn strengthens its financial stability. However, Vietnam can't ignore regional competition. If neighboring currencies like China's yuan or Thailand's baht weaken, Vietnam has to tread carefully. A dong that's too strong could hurt export demand. That's why the SBV's strategy will likely remain one of controlled appreciation, moving just far enough to reflect growth, but not so far that it disrupts trade. Many economists now believe we're witnessing the early stages of a long-term revaluation journey. It's not a one-time adjustment. It's a process, possibly spanning several years, where the dong gradually rises in value in sync with the country's growing influence in global trade. This is exactly what happened in South Korea, Taiwan, and China when they transitioned from low-cost exporters to more balanced, innovation-driven economies. Vietnam is following a similar path, and the benefits go beyond exports. A stronger dong means more purchasing power for Vietnamese citizens, cheaper imports, and increased consumer confidence. It also signals to global investors that Vietnam's economy is stable, transparent, and ready for more international capital. This combination of internal confidence and external credibility could push Vietnam into a new era of economic maturity. At the end of the day, what we're seeing isn't hype. It's the natural evolution of a thriving economy. The State Bank of Vietnam's cautious yet confident policy moves, combined with the nation's strong economic fundamentals, are setting the stage for what could be one of the most meaningful currency stories of this decade. For global watchers, and especially for holders of the Vietnamese Dong, this could mark the beginning of a long-awaited chapter where patience finally starts to pay off. And for those tracking both IQD and VND, it's another reminder that the world's emerging economies are quietly and steadily reshaping the global monetary map. Stay tuned, because this story is far from over. As always, we'll be tracking every development, every rate update, and every move from the State Bank of Vietnam. You're watching Iraqi Dinar, where we break down complex currency news into clear insights. Don't forget to like, share, and subscribe for more real-time updates on the Dong, the Dinar, and the revaluation discussions that just won't quit.